Picture this. You see a business owner pull up in a brand new $120,000 Range Rover. And your first thought is probably, wow, that guy is terrible with money. But what if I told you that Range Rover might actually be one of the smartest financial moves they made all year? Because they didn't just buy a luxury SUV. They bought a tax deduction. And depending on their income, the IRS may have helped pay for part of it. Sounds insane, right? But there's one strange rule buried deep in the tax code that changes everything. A single number, 6,000 pounds. And if your vehicle weighs more than that, the IRS starts treating it less like a car and more like business equipment. In this video, we're going to break down exactly how this SUV tax strategy works. You'll learn why the 6,000-pound rule exists, how Section 179 can turn a luxury vehicle into a major tax deduction, and, most importantly, the mistakes that can cost you thousands if you get it wrong. Because despite what social media gurus claim, this isn't a free car hack. It's a tax strategy, and there's a huge difference. I'm Merrick. I break down the financial concepts, tax strategies, and money lessons schools never taught us. If that sounds interesting, make sure to subscribe and leave a comment below. Now let's see why a $120,000 Range Rover can sometimes be cheaper than a regular car. Most people think taxes are simple. You make money. The government takes a percentage. End of story. But wealthy business owners know something different. The tax code is full of incentives. The government wants businesses to spend money, grow, hire employees, and invest in assets. So instead of rewarding people for simply saving cash, the system rewards people who buy things that help generate income. And one of the weirdest examples of that is something called Section 179. This is the part of the tax code that allows businesses to deduct certain purchases immediately instead of slowly over time. And yes, that can include luxury SUVs. Now here's where things get weird. Normally, if a business buys a regular car, like a Honda Accord or Toyota Camry, the IRS limits how much can be deducted each year. Why? Because the government assumes people might abuse the system by buying luxury personal vehicles and pretending they're business expenses. So they created strict depreciation limits for standard passenger cars. But then comes the loophole. Vehicles with a gross vehicle weight rating, or GVWR, above 6,000 pounds fall into a completely different category. Instead of being treated like a normal passenger car, they can qualify for Section 179 deductions, meaning businesses may be able to deduct a massive portion of the vehicle cost immediately. That includes vehicles like Range Rovers, Mercedes G-Wagons, Cadillac Escalades, Tesla Model X, certain pickup trucks, large SUVs. And this is why you constantly see successful business owners driving giant luxury SUVs. To the average person, it looks flashy, but financially, the owner may be thinking, this vehicle is reducing my taxable income. Now let's look at the actual math, because this is the part most people never understand. Imagine your business made $100,000 in profit this year, and let's say your effective combined tax rate is around 30%. Without deductions, you could owe roughly $30,000 in taxes. That money disappears. Gone. Straight to the IRS. But now imagine you buy a qualifying SUV for business use. Under Section 179, you may be able to deduct a huge portion of that purchase immediately. So instead of being taxed on the full $100,000, maybe now your taxable income drops dramatically. That means your tax bill drops too. So instead of paying $30,000 entirely to the government, part of that money was redirected into an asset you own. That's the key idea. The wealthy often buy assets using pre-tax dollars while everyone else buys things using after-tax dollars. And that changes the entire game. Because if you're in a 30% tax bracket, every dollar spent personally requires earning about $1.43 before taxes. But business deductions reduce that burden. Again, the car is not free. This is important. You are still spending real money. But the tax code can reduce the real cost significantly. And once people realize this, they start viewing business expenses very differently. Now you might be wondering, why would the government even allow this? Why would they basically subsidize luxury vehicles? Because technically, the government doesn't care about the luxury. They care about economic activity. The IRS rewards spending tied to business growth. If a company buys equipment, that helps manufacturers. It helps dealerships. It helps workers. It stimulates the economy. And historically, Heavy vehicles were associated with construction, farming, transportation, and commercial work. The loophole exists because these rules were originally designed to help businesses buy work vehicles. But over time, luxury SUVs got bigger and heavier. So now some high-end vehicles accidentally qualify for rules originally intended for commercial equipment, which creates this strange situation where a $120,000 luxury SUV can receive better tax treatment than a normal sedan. Tax code is weird. Now before you start shopping for a G-Wagon tomorrow morning, there's a catch. Actually, multiple catches. The biggest one, business use. To qualify for these deductions, the vehicle generally needs to be used for business more than 50% of the time. That means real business use. Client meetings, work travel, business operations, company activities. Not, yeah bro, I thought about business while driving to the beach. The IRS expects documentation, mileage logs, business records, proof. Because if they audit you and discover the vehicle was mostly personal use, those deductions can disappear very quickly. And yes, the IRS can come back and demand money later. Think of it like borrowing trust from the government. If you abuse the system, they take it back. And honestly, this is where social media completely misleads people. You'll hear influencers say, buy a G-Wagon and pay zero taxes. That's not how this works. The deduction reduces taxable income. It does not magically erase the cost of the vehicle. And this leads to the biggest mistake people make. They buy the car before they actually have the income. That is backwards. A tax write-off only helps if you have profits to offset. If your business made barely any money, buying an expensive SUV to save taxes makes no sense, because you're still spending far more money than you're saving. And this is how people end up fake rich. They finance luxury cars, chase deductions, and convince themselves they're beating the system. Meanwhile, they're drowning in debt. Real wealthy people think differently. They make money first. Then they use the tax code to legally reduce what they owe. The tax strategy comes after profitability, not before. That distinction matters a lot. And honestly, the SUV itself isn't even the important part. The real lesson is this. The wealthy study the rules. Most people spend years learning how to make money, but almost no time learning how money is taxed. And taxes are often the single biggest expense in a person's life. Bigger than food, bigger than entertainment, sometimes even bigger than housing. So wealthy business owners obsess over deductions, structures, timing, depreciation, and incentives. Not because they're cheating, but because the rules literally reward people who understand them. The tax code is basically a giant instruction manual for what the government wants people to do. Invest, build businesses, buy assets, create jobs. And once you understand that, you stop seeing taxes as random punishment. You start seeing them as a game with rules. So no, the rich aren't magically buying free Range Rovers, but they are using knowledge most people never learn. And sometimes, that knowledge can save tens of thousands of dollars. The craziest part? None of this is secret. The tax code is public. Most people just never read it. I'm Merrick, and I break down the financial concepts schools forgot to teach. If you enjoyed this video, subscribe. And next, you should watch this video right here. Because there's another invisible system quietly stealing money from almost everyone. Inflation. And once you understand how the wealthy protect themselves from it, you'll never look at cash the same way again.